Good day, everyone. This is Arogo Speaks on Arogo Insights. Today, we are going to talk about something very important, the Bank Recapitalization Directive of the Central Bank of Nigeria, implications for financial stability and economic growth. The Central Bank of Nigeria launched its banking sector recapitalization directive in March 2024 to address the erosion of the capital basis of Nigerian banks due to prolonged naira devaluation, high inflation, and currency fluctuations since the last major exercise in 2004. These factors had significantly reduced the United States dollar equivalent value of banks, shareholders' equity, and overall competitiveness on the continental stage, as highlighted in very recent data taken from 2025. While the top 10 banks in Nigeria boasted combined total assets exceeding 223 trillion naira, which is approximately 140 to 150 billion US dollars at prevailing exchange rates of 1,450 to 1,550 naira per United States dollar. This scale remained notably smaller than that of the leading institution in Africa, the Standard Bank Group of South Africa, with assets around 190 to 120 billion United States dollars alone. Individually, no Nigerian bank approached the size of top South African or North African peers. National Bank of Egypt is valued at over $165 billion. Attijari Wafa Bank of Morocco is valued at 78 to 95 billion, underscoring a gap in capital depth that limited the ability of Nigerian banks to finance large-scale projects, withstand economic shocks, or expand Pan-African operations robustly. The directive raised minimum paid-up capital requirements substantially for international banks from 50 billion to 500 billion, national banks to 200 billion, and regional banks to 50 billion to restore resilience, enhance solvency, and align with the ambition of Nigeria to achieving a $1 trillion economy by 2030. By late 2025, with the March 2026 deadline approaching, significant progress had been made. Around 16 of the 36 banks in Nigeria had fully complied, many through rights issue, public offers and mergers, while the sector as a whole demonstrated ongoing stability and no imminent risks of closures. The initiative of the CBN not only counters the relative decline in global competitiveness illustrated by continental comparisons, but also positions Nigerian banks for greater economic contributions to economic growth, financial inclusion, and regional influence amid ongoing digital transformation and consolidation. What then is, let's look at the banking sector in Nigeria. In Nigeria, we are good at coming up with fine policies. Sometimes the implementation is suspect. The banking sector in Nigeria has long been the cornerstone of economic development, facilitating credit allocation, payment systems, and financial intermediation. However, current crisis stemming from poor governance, asset quality deterioration, and external shocks have necessitated periodic interventions, including recapitalization mandates by the CBN. The latest directive, issued on the 28th of March 2024, requires banks to raise the minimum capital basis significantly over a 24-month period ending March 31st, 2026, categorizing requirements by license type. The CBN structures its licensing framework for deposit money banks based on operational scope, with categories including international commercial banks, national commercial banks, regional commercial banks, and non-interest banks. These classifications determine the geographic reach, services offered, and minimum capital requirements under the ongoing 2024 Recapitalization Directive. As of December 2025, the Nigerian banking sector comprises approximately 34 to 36 licensed commercial banks, influenced by recent mergers, acquisitions, and compliance efforts, though exact numbers fluctuate with regulatory approvals. International commercial banks hold the broadest authorization, permitting operations both within Nigeria and abroad, including foreign subsidiaries and cross-border transactions. They face the highest capital threshold of 500 billion naira. The 7 banks in this category represent the largest and most globally oriented institutions. The Access Bank Limited, Fidelity Bank PLC, First Bank of Nigeria Limited, First City Monument Bank Limited, Guarantee Trust Bank Limited, United Bank for Africa PLC, and Zenith Bank PLC. These banks dominate the sector in terms of assets and international presence, having largely met or exceeded recapitalization targets through rights issues and private placement. National commercial banks are authorized for nationwide operations within Nigeria, but without full international scope in certain advanced areas. They require a minimum capital of 200 billion. This category includes a diverse group such as Citibank Nigeria Limited, EcoBank Nigeria Limited, Keystone Bank Limited, Polaris Limited, Stanbic IBTC Bank Limited, Standard Chartered Bank Limited, Sterling Bank Limited, Union Bank of Nigeria PLC, following its merger with Titan Trust Bank, and then Wema Bank PLC, Premium Trust Bank Limited, and Optimus Bank Limited, among others. Recent mergers and capital raises have strengthened several in this group, with banks like Stanbic IBTC and Wema achieving compliance, while others continue efforts amid consolidation pressures. Regional commercial banks operate within designated geographic zones or states with a lower capital requirement of 50 billion, allowing focused services in specific areas due to recapitalization challenges. This category has seen significant contraction through mergers or upgrades. Notable examples include Paralex Bank Limited, SunTrust Bank Nigeria Limited, and Signature Bank Limited. Providence Bank Limited, previously regional, has effectively upgraded following its merger with Unity Bank, reflecting the trend of smaller banks seeking national status or absorption to survive. Non-interest banks adhere to Sharia-compliant principles, prohibiting interest and emphasizing ethical profit-sharing models. Most hold national authorization with a 20 billion capital requirement, though regional options exist at 10 billion naira. This segment promotes financial inclusion in undeserved communities. The primary institutions are Jay's Bank PLC, TAJ Bank Limited, Lotus Bank Limited, and the Alternative Bank Limited, with Summit Bank Limited recently licensed as a newer entrant focused on regional non-interest services. Several, including Jay's and Lotus, have successfully met recapitalization threshold, positioning them strongly within the ethical banking niche. This policy responds to post-COVID vulnerabilities, inflationary pressures, and currency volatility, aiming to fortify banks against risk and align with global standards like the Basel III. Historically, recapitalization has transformed the fragmented banking sector or landscape in Nigeria into a more consolidated and resilient system, as evidenced by the 2004 to 2005 exercise that reduced 89 banks to 25. Yet questions persist regarding its equity, efficiency, and long-term impacts on financial inclusion. In this lecture, we will provide a comprehensive analysis structured to explore the evolution of recapitalization since 1999, its legal underpinnings, post-implementation benefits, inherent merits and demerits, forward-looking strategies, and concluding insights. As always, by integrating legislative reviews, case studies, and recent data as of December 2025, we'll evaluate the CBN Directive potential to drive sustainable growth while addressing challenges in the emerging economic sector or context. The analysis is grounded in regulatory theories, emphasizing financial stability, and draws implications for international conferences on banking world reforms. The history of bank recapitalization in Nigeria. The trajectory of bank recapitalization in Nigeria reflects a pattern of reactive reforms to systemic distress, evolving from colonial era foundations to modern prudential measures aimed at building a resilient financial system capable of supporting economic growth. The origins of the formal banking regulation date back to the colonial period, with the first banking ordinance enacted in 1952, which established basic entry requirements and supervisory oversights for banks operating in the territory. This was followed by incremental increases in minimum capital requirements, such as the raise in 1958, reflecting early efforts to ensure stability in a nascent sector dominated by foreign banks like Barclays and Standard Chartered. Post-independence in 1960, the establishment of the CBN in 1959, and then the Banking Act of 1969 further strengthened controls, maintaining real stability until the liberalization era of the 1980s and 1990s introduced new vulnerabilities. The deregulation under the Structural Adjustment Program (SAP) in 1986 dramatically expanded the banking sector, with bank licensing liberalized, leading to the surge from about 40 banks in 1986 to over 120 by the early 1990s. While this fostered competition and financial deepening, it also sowed seeds of distress through lax oversight, rapid expansion without commensurate risk management, and economic shocks like inflation and naira devaluation. By the mid-1990s, widespread insider abuse, fraud, poor corporate governance, and high non-performing loans plagued the banking industry, with non-performing assets reaching an alarming level. At its peak in the late 90s, over 30 banks were classified as distressed or terminally insolvent, eroding public confidence and contributing to a situation where an estimated 50% of currency circulated outside the banking sector. In response, the Nigerian Deposit Insurance Corporation (NDIC), established in 1988 and operational from 1989, played a pivotal role in crisis management. Throughout the 1990s, the NDIC, in collaboration with the CBN, provided liquidity support to troubled banks, took over management of dozens of distressed banks, and facilitated restructurings. The failed banks, recovery of debts, and financial malpractices in banks, Decree number 8 of 1994, empowered special tribunals to recover debts and prosecute offenders, recovering billions in assets and sanctioning malpractices. By 1998, these interventions culminated in the liquidation of 26 distressed banks, 13 commercial and 13 merchant, significantly reducing the number of operational banks to around 89 and pruning branch networks. The return to civil rule in 1999 under President Olusegun Obasanjo marked a transitional phase towards broader reforms. In the immediate post-military era, the NDIC continued aggressive resolution efforts acquiring and restructuring 7 distressed banks for handover to new investors between 1999 and 2000. To prevent recurrence and strengthen new entrants, the CBN raised the minimum paid up capital requirement for newly licensed banks from 50 million to 500 million, signaling a shift towards prudential standards. This measure, alongside gradual increases for existing banks, progressing to 1 billion naira by 2000 and 2 billion naira by 2001, aimed to foster stability, curb insolvency risk, and promote efficiency in a sector still healing from the 1990s crisis. These early democratic era adjustments laid critical groundwork for the more transformative 2004 to 2005 consolidation exercise, transitioning banks in Nigeria from a period of fragility and frequent failures to one oriented towards global competitiveness and systemic soundness. In 2004 to 2005, banking sector consolidation in Nigeria, spearheaded by the then CBN Governor, Professor Charles Chukwuma Soludo, now the Governor of Anambra State, represented a landmark reform aimed at addressing long-standing structural weaknesses in the financial system. Announced on March 2004 as part of a broader 13-point agenda, the policy mandated an increase in the minimum paid up share capital for commercial banks from 2 billion to 25 billion, that is approximately 195 million US dollars as at the time, by December 31st, 2005. This directive was driven by the recognition that the pre-reform banking landscape was characterized by fragility, with 89 banks operating as of mid-2004, many of them small, undercapitalized, and plagued by poor governance, high non-performing loans, persistent illiquidity, and over-reliance on public sector funds. Notably, the largest banks had a capital base of only about 240 million US dollars, far below global standards, while the top 10 banks controlled over 50% of total assets, deposits, and credits, leaving the majority marginal and vulnerable to shocks. Banks were given an 18-month window to comply through fresh capital injections, mergers, acquisitions, or a combination thereof, with the explicit goal of creating stronger, more competitive institutions capable of supporting the developmental needs of Nigeria and competing regionally and globally. The process was remarkably market-driven, avoiding government bailouts or forced liquidations initially. By the deadline, 75 banks successfully consolidated into 25 stronger entities through 54 mergers and acquisitions, while 14 failing banks had their licenses revoked in early 2006. The consolidated banks raised over 406 billion in fresh capital, with 360 billion verified by the CBN, supplemented by significant foreign direct investment inflows. The aggregate capital base of the sector surged dramatically from around 50 billion pre-reform to over 2 trillion post-consolidation. Laudable achievement, transforming the collective capitalization of the banking sector approximately 3 billion equivalent in stronger institutions. This consolidation profoundly enhanced the global competitiveness and profitability of the banking sector. Post-reform banks benefited from the economies of scale, improved risk management, and expanded branch networks, leading to a surge in assets, growing over 700% in some estimates by 2010, higher profitability ratios, and greater lending capacity to the private sector. The reforms positioned Nigerian banks as emerging players in Pan-African finance, with institutions like UBA and Access Bank expanding aggressively across the continent. Confidence in the system was restored, as evidenced by increased deposit mobilization. Much of the estimated 83.9% of currency outside the banking system pre-reform was drawn in, and a shift towards private sector-driven growth. However, the exercise came at significant social and economic cost. The rapid pace of mergers and acquisitions led to substantial job losses, with thousands of redundancies as overlapping roles were eliminated and branches rationalized, contributing to short-term unemployment pressures in the financial sector. Moreover, the emergence of larger megabanks raised concerns about reduced access for small and medium-sized enterprises, SMEs, which had previously relied on smaller community-oriented banks for credit. The consolidated institutions focus on profitability and risk aversion, often prioritize large corporate clients and high-margin activities, resulting in tighter lending criteria, higher interest rates for smaller borrowers, and a temporary decline in SME financing. This exacerbated financial exclusion in rural and underserved areas, where branch closures occurred during restructuring. In retrospect, the consolidation of Soludo laid a robust foundation for a modern banking sector in Nigeria, fostering resilience that helped withstand subsequent challenges like the 2008 to 2009 global financial crisis. Though vulnerabilities persisted, leading to further interventions, while it achieved its core objective of stability and scale, the trade-offs, particularly job disruptions and SME credit constraints, highlighted the need for complementary policies on financial inclusion and manpower retraining in future reforms. Let us move further. Under the tenure of Sanusi Lamido Sanusi as governor of the CBN from 2009 2014, there was no broad-based recapitalization mandate akin to that of 2004 to 2005 consolidation under Governor Charles Soludo, or the ongoing exercise in 2004 to 2006. The reforms of Sanusi Lamido Sanusi address the aftermath of the 2008 global financial crisis, which exposed vulnerabilities in Nigerian banks stemming from excessive exposure to margin lending, oil and gas sectors, and poor governance post the earlier consolidation. In August 2009, following a special audit of all the 24 banks, the CBN identified 10 banks in severe distress, later focusing on 9 of them, including Afribank, Intercontinental, Oceanic, Union Bank, Finbank, Bank PHB, Equatorial Trust, Spring Bank, and Wema. Sanusi removed the CEOs of these banks and executive directors of these institutions and injected approximately 620 billion naira in bailout funds as subordinated loans to restore liquidity and prevent systemic collapse. To facilitate recovery, the CBN pioneered the establishment of the Asset Management Corporation of Nigeria, famously referred to as AMCON, in 2010, which acquired non-performing loans worth trillions of naira from the affected banks in exchange for bonds. These clean balance sheets and enable recapitalization. Distressed banks received deadlines, initially September 2011, to raise fresh capital privately through mergers, acquisitions, or equity injections. Successful cases included mergers Oceanic into EcoBank, Intercontinental into Access, while failures led to nationalization. 3 banks, Afribank, Bank PHB, Spring Bank, had licenses revoked with assets transferred to bridge banks, which were Main Street, Keystone, and Enterprise, fully recapitalized by AMCON. These targeted interventions stabilized the banking sector without depositor losses, restored confidence, and earned Sanusi Lamido Sanusi international acclaim. In 2010, he won as the Central Bank Governor of the Year. However, they highlighted persistent governance issues and contributed to ongoing consolidation, reducing the number of banks further. Subsequent minor adjustments occurred, but the 2024 Directive represents the first comprehensive mandate since 2005, excluding retained earnings from compliance to ensure fresh capital infusion amid naira devaluation and inflation exceeding 30%. As of December 2025, 16 of the 36 commercial banks have met the requirements with mergers like Unity Providus, accelerating consolidation. These episodes illustrates the role of recapitalization in evolving banking from fragility to resilience in Nigeria, often through triggering short-term disruptions. Let us look at the legal and institutional framework for banking in Nigeria. The Recapitalization Authority of the CBN is enshrined in a robust legal architecture, ensuring directives are enforceable and aligned with financial stability objectives. The Banks and Other Financial Institutions Act of 2020 serves as the primary statute, repealing its 1991 predecessor to modernize regulation. Section 9 of BOFIA empowers the CBN to prescribe minimum paid-up capital by license category. And look at sections 12, 33 to 35 of BOFIA, authorized license revocation, director removal, and interventions in distress scenarios. Complementing BOFIA, the Central Bank of Nigeria Act 2007, Section 2 sub D, mandates the CBN to promote a sound financial system, granting supervisory powers under Section 47. Institutional support includes the NDIC for deposit protection up to 5 million per depositor, and AMCON for asset resolution. The 2024 circular operationalizes these, requiring CBN approval for mergers, exempt from competition laws to prioritize stability. Judicial precedents affirm the constitutionality of this legal framework. In Omoyeni and CBN, a 2010 decision, the Court of Appeal upheld the emergency powers of the CBN under BOFIA, emphasizing public interest. Again, in Dancing, Izedonwen and Union Bank, a 2011 decision validated board removals during crisis. This interplay of laws and institutions ensure legitimacy of the Recapitalization Directive with penalties for non-compliance, including fines up to 10 million naira or imprisonment. Let us look at the benefits of post-recapitalization. Post-recapitalization phases in Nigeria have yielded tangible benefits, enhancing sector robustness and economic contributions. Following the 2005 exercise, banking assets surged 700% by 2010 with improved profitability and risk absorption. The 2004 directive is poised to similarly bolster resilience, enabling banks to withstand microeconomic shocks like the 34% inflation in 2025. Key benefits include enhanced lending capacity, supporting the lofty and ambitious $1 trillion GDP target of the federal government through increased credit to real sectors. Recapitalized banks exhibit stronger capital adequacy ratios, reducing insolvency risk and attracting foreign investment. Post-2009 interventions via AMCON stabilized deposit, boosting consumer confidence. Furthermore, recapitalization fosters innovation, with banks investing in digital infrastructure for broader inclusion. Economies of scale from mergers, lower cost, improving efficiency, and global competitiveness are seen in expanded Pan-African operations. Overall, these outcomes underscore the role of recapitalization in systemic soundness. What are some of the merits and the demerits of bank recapitalization? Recapitalization offers merits that strengthen the banking ecosystem in Nigeria, but also present demerits warranting further scrutiny. What are some of the merits? Although earlier highlighted, recapitalization enhances financial stability by improving loss absorption, as evidenced by the post-2005 profitability gains. The boosted investor confidence attract capital inflows, while increased liquidity supports forex market stability. For SMEs, expanded reach via technology investment promotes inclusion. Mergers yield efficiencies, reducing operational costs and enhancing shareholder value. What are some of the demerits of consolidation? Risks oligopoly, diminishing competition, and raising lending rates for borrowers. Smaller banks face extinction, potentially excluding underserved segments. Short-term disruptions include job redundancies and market volatility during capital raises. Moreover, reliance on equity markets may exacerbate inequality if benefits accrue disproportionately to large institutions. Balancing these require nuanced policy designs to maximize merits while addressing demerits. What then is the way forward? Let us look at a few policy recommendations. As the 2004 capitalization nears completion by March 2026, strategic measures are essential for sustainable progress. The CBN should prioritize tiered support for mid-sized banks, facilitating mergers without undue pressure, as seen in ongoing right issues and private placements. Enhancing regulatory oversight through digital tools will ensure compliance and transparency. Investing in financial literacy and SME-focused products can mitigate inclusion gaps. International partnerships for capital inflows, coupled with Basel-compliant risk management, will strengthen resilience. Finally, let it be noted that periodic reviews post-2026 will adapt to evolving challenges, fostering a dynamic banking sector. By way of concluding, The Recapitalization Directive of the CBN embodies a proactive stance towards financial stability in the volatile economy of Nigeria. While historical precedents demonstrate its efficacy in consolidation and growth, the legal framework ensures equitable enforcement. Benefits like enhanced lending and confidence outweigh demerits if managed astutely. Moving forward, inclusive reforms will unlock the potentials of the banking sector, contributing to broader development goals. This analysis advocates for vigilant implementation, positioning banks in Nigeria as pillars of regional prosperity. I want to thank you for listening. Please, if you've not subscribed to our channel, Arugu Insights on YouTube, please do so. And if you're not following us on the other social media networks, X, TikTok, Instagram, and Facebook, please follow us so that you'll be updated with what we are doing. Thank you.